You see the headlines, buy this ETF, get rich quick. But here's the dirty secret. Most people are making three massive mistakes that quietly sabotage their returns, turning those promised riches into major losses. We're not talking about missing out on a few percentage points. We're talking about fundamental errors that can sink your entire long-term plan. Stick around, because if you own an ETF, and you probably do, you need to know these. The first mistake? Assuming diversification means safety. An ETF holds many stocks, yes, but what stocks? Many popular funds tracking major indices are heavily concentrated in just the top 5 to 10 companies. Think about it. If 25% of your ETF's value is in just 2 or 3 tech giants, is that really diversified? If those few companies suddenly tank, your entire ETF is going to feel the pain. Here's the pattern break. Don't just buy the ticker symbol. Check the top holdings. It's like buying a variety pack of chips only to find out 80% of the bag is plain potato chips. You need real diversification. Mistake number 2 is crucial. Chasing last year's winner. We all love a good chart showing 50% returns, but past performance is a terrible predictor of the future. The ETF that soared last year might be dead money this year. By the time the hot story makes it to the news, the big gains have often already been made. When you invest based on a year-end performance chart, you're essentially buying high. You need to focus on the ETF's strategy. Does it align with your long-term goals and risk tolerance? Not what some analysts said was hot 3 months ago. And the final wealth-destroying mistake? Ignoring the invisible fees and errors. Yes, ETFs are generally low cost, but a small tracking error combined with an expense ratio, even if it's just 10 cents for every $100, will compound into thousands of dollars lost over 20 or 30 years. A good ETF should track its underlying index almost perfectly. If your S&P 500 ETF is consistently underperforming the actual S&P 500 by even a tiny margin, that's called tracking error, and you are paying for it. Stop letting these mistakes quietly drain your wealth. Investing is a long game built on solid fundamentals, not on hype or past results. If this opened your eyes, hit like, subscribe, and share it with someone who still makes these mistakes.